Alright guys, here I am with a brand new video, with another video, another lecture video actually. In this video, we're going to talk about the sixth chapter, chapter number 6, and then we're going to talk about the ratio analysis. We're going to do ratio analysis, and it is very important for hospitality operations. We will talk about a whole bunch of stuff in this chapter, guys. As you can see, let me scroll down to show you the lecture outline. Let me just go over the lecture outline briefly, and everything will be shown for today's discussion, for this video's discussion. Before that, I remind myself. Before that, please check your schedule, check your syllabus, course agenda. Please try to stay on top of everything. If you are any assignment coming up, please don't forget to meet the deadline. And if you have any questions, as always, please do not forget to send me an email, make an appointment to come see me in my office, or any other tools that you can use to reach me out. Reach out to me. So, guys, what we're going to do today, we're going to discuss the outlook of ratio analysis. What are they? What are the users of ratio analysis? What is the usage of ratio analysis? The purpose of ratio analysis? The need for ratio analysis? Ratio types, and then the different corners and edges and different dynamics of ratios. We're going to talk about this in this lecture. And of course, we will be decomposing the entire ratio analysis into 5 different categories, as you can see over here. And then we will discuss all of them, one by one, because every single one of them, 1, 2, 3, 4, 5, 6, 5 right here, every single one of them has the sub ratios we will talk about, and then in total, we will be analyzing probably around 30 different ratios with 30 different equations and examples, of course, in this video lecture. Okay, so if you're ready, let's just jump to the lecture, and then let's talk about ratio analysis itself. Guys, ratio analysis, it is a comparison. It is a pure comparison of 2 different values based on a given fiscal year, and it is the decision-making tool based on this comparison for operations, strategic and finance decisions. So as you can see in the lecture notes, we have to have 2 values to compare something, or 2 different years with 2 different values, and then we'll have to have facts and figures, operational facts and figures based on a numerical value, and then the ultimate source of those figures, of the values, are the financial statements. Bottom line, we will be using financial statements or specific parts of financial statements to retrieve those values to come up with a ratio analysis, so that we can do the comparative analysis, we can do the comparisons, so we can come up with a strategic and financial decision for the company's performance, operational performance, so on and so forth. Okay. Well, ratio analysis are used to identify trends over time. Okay. Trends meaning the pattern of happening. For example, if you are analyzing any ratio based on your assets, it will show the assets changes, relative to different years, different week, different periods, different quarter, and then it will show you a nice graph in trend analysis. Therefore, ratio analysis allows us to do this as decision makers. Okay. Also, it provides insights about the company's operating earnings, credit sales, level of debt, revenue expense balances, seat turnover, employee turnover, revenues created per room, per occupancy, per sales, and per customer. Okay, efficiency in asset usage. Therefore, the ultimate purpose of ratio analysis becomes, guys, let me just clean the screen. The ultimate purpose becomes that ratio analysis as a tool allows decision makers, financial analysts, or any type of financial accounting person, a revenue person, to watch, monitor, to assess what's going on in the company in terms of operations, in terms of financial stuff. Okay, so we can come up with the financial performance, efficiency, profitability, and revenue expense debt balance by running ratio analysis. There are a lot of users for the ratio analysis. Even employees, even us employees can be a great user for ratio analysis, but I will give you such examples over here that it will give you a clear picture of the users of ratio analysis. Guys, users of ratio analysis can be investors, can be companies, can be credit lending institutions such as banks, can be a government, can be tax people, can be IRS, which is tax people actually, can be employees, can be employees' wife for retirement purposes, for example, can be other companies, competitors, to look at the ratio analysis to come up with a healthy decision and healthy financial objectives and investment strategies or money managing strategies. Different ratios read in different ways. Okay. For example, many of the ratios are expressed by percentages, but some of them are expressed by units and the absolute value of the numbers. For example, it could be just number 4. 4. What is 4? We don't know. Maybe 4 times, maybe 4 days, maybe 4%. Okay, or maybe it represents the frequency of usage. So we will be talking about all these. Therefore, we will read different ratios in different ways, and then we have 5 different categories, and then we will see what they are. We will see how to read them as well. Okay, so again, ratios are the fractions where the numerator is expressed as a portion of a denominator. It's just like x over y, and there's a number over here, let's say z, there's a number over here, and we will be interpreting the number z over here, or z, whatever you want to call. So therefore this fraction analysis becomes a ratio. Of course, we have some equations as well. We have equations for fractions as well. For example, something like this, and we will be able to find out this x over here. Okay, so we will see all these analysis. We will see and analyze the examples as well, and everything will be very clear, and I will be as explanatory as possible when we get to the ratio analysis. When we get to the examples, I'm sorry. Again, I said there are different people, several different financial ratios, and there are different users, and there are several different financial ratios are demanded by different type of parties. For example, let's talk about the creditors. Who are the creditors? They are the banks, they are the lenders. They do have the money, they have pool of money, and they lend money to people, okay, or the businesses to perform in business tasks or to get into any investments in the hospitality industry. Again, investments are very important for the hospitality industry. Therefore, trying to read, trying to analyze, trying to assess companies' financial situation, financial condition, and operational efficiency becomes extremely important for different types of parties, because they will get to decide and they will do the final decision-making process. For example, the creditors. We are talking about creditors right now. Creditors, they take a look at debt ratios, solvency ratios. Why? Because if any company, any hospitality business, for example Marriott, if Marriott has a lot of debt on their balance sheet, assets, liabilities over here, and the equities or equity section is over here. If a specific company has a lot of debt, it might be difficult for that company to acquire additional debt due to risk issues. Therefore, solvency ratios are great indicators for creditors to assess companies' liability situations, and therefore the debt condition. Therefore, they will be able to decide if they can issue additional debt, or if they can put out additional loan amounts for that specific company. Therefore, it becomes very important. This was just such an example, but we can just advance those examples, and I will be just throwing out examples when I walk you through the in-class exercises. Okay, guys, we talked about 5 classes of different ratios. The first one is the liquidity one. Liquidity, what is it? Guys, liquidity means that companies being able to be a liquid company, meaning liquidity shows the condition where company is able to pay its short-term debt obligations with the short-term assets. Meaning, in other words, if the company is able to pay its current liabilities with current assets, that means that company is said to be a liquid company, meaning company has enough cash, company is able to generate enough cash using the assets to be able to pay short-term debt obligations, short-term payment obligations, which are short-term notes payable, accounts payable, those kind of stuff. Please remember the balance sheet when I'm talking about this from chapter 5. Therefore, it will be much more clear. Okay. We have a lot of liquidity ratios, okay, and then I will walk you through the most important ones over here, and of course the current ratio, current ratio, you can see it over here, guys, okay. Current ratio is the most common liquidity ratio. It shows the ability of a company to pay its current liabilities, current obligations against using their current assets, against their current assets, meaning this ratio answers this question. Do I have enough current assets to be able to pay my current liabilities? If there is yes, we will calculate that. If there is no, we will calculate that, and then yes, no answer will be clear based on this. So guys, another thing I would like to mention over here, okay, we will do some in-class exercise right now, right here, an example for the current ratio, but before we do it, we always compare company's current ratio, okay, with a benchmark of 1. This one is right here. Let me just put it in a circle. This one is the absolute value of 1, okay? So whatever we have as a current ratio, we will do this comparison with the benchmark, which is 1, and then we will get to interpret the result by looking at the current ratio, and we will do this for every single ratio we have in this lecture, guys. So let me remind you one thing before I read the first in-class exercise in chapter 6. Guys, here's what we're going to do. We will come up with a ratio analysis, current ratio, the other ratios, right? Okay, we will do this. However, the calculation process is not heavy, is not difficult. Therefore, what we have to do, or the biggest takeaway from this lecture is that we should be able to interpret the numbers that we have from the ratio analysis. Okay, this is the most important takeaway, the most critical approach that we need to have, and we need to learn. You need to learn from this class. Take a look at this. I will elaborate more using the examples. Excuse me. Mag's luxury resort has a total of $1,340,000 in current assets and $1,090,000 in current liabilities. What is the current ratio? Guys, very straightforward question. What is the current ratio? Take a look at this. Let me just put this in the brackets. Current ratio, let's say CR, is equal to current assets over current liabilities. Total current assets over total current liabilities. Well, when we analyze the specific component of the equation, this guy is given to us and this is given to us. All we have to do for MAG, we have to plug in the numbers. As you can see, please take a look at my please take a look at my solution steps over here. As we can see, when I plug in the numbers, okay, this is my total current assets and this is my total current liabilities. When I plug in the numbers, I have 1.23 times, okay, or 1.23 to 1. 1 is the benchmark. We know this, never forget. For the current ratio, whatever we have, okay, whatever the company's current ratio is, we will always compare it with 1, which is the benchmark in the current ratio. So, guys, okay, my current ratio is 1.23, but what does that mean? The most important thing, as I said a couple of minutes earlier, is to be able to interpret the data, interpret the number we have, okay, and now that's what we're going to do here. So guys, take a look at this. 1.23 times means that for every $1 of current liabilities, this resort has $1.23 in current assets, meaning you have $1.23 in current assets to pay off a dollar worth of your current liabilities, which means since your current ratio value is above 1, that means you are a liquid company. That means you are able to pay off your short-term obligations using your current assets, and you still have 23 cents to be used for other purposes: dividend payments, employee bonuses, salary increases, for other investments. We will talk about all these in Financial Management 44-64 class. So this is exactly what it means. And of course, if you're a company, you want your, of course you're going to be working in a company, but as a company, you want your current ratio to be high as possible. For the hospitality industries, we don't have high current ratios. It is usually around 1.20, 1.30, 1.40. But you get the point that as a company, as a decision maker, you always want your current ratio to be higher than 1, which is the benchmark. Therefore, it will financially benefit to you. Therefore, you will be able to repay your short-term obligations using your current ratio easily. Okay. Another liquidity ratio we have is the quick ratio. QR is equal to, okay, well, I'll talk about this, quick ratio or asset test ratio. Guys, this ratio also shows hospitality companies' ability to pay short-term debt obligations using current assets, which are the short-term assets, okay? Well, the difference between, since they're the same thing, you might want to ask, okay, then what is the difference between CR and QR? CR current ratio, QR quick ratio, or asset test ratio? The biggest the importance is the inventory. I will touch base with it in a second. Okay, the inventory. Quick ratio, since we're talking about it, quick ratio is a more stringent and more accurate liquidity analysis for the companies because it is more stringent test of liquidity. Why? Because of the inventory. Inventory is hard to control sometimes. Inventory might be sold at 100% capacity, or inventory might not be sold. So since inventory is so fragile thing to consider in analysis, in mathematical analysis, quick ratio excludes inventory calculations. Please remember, we had current assets right here, the same current assets, right? What we have under current assets, we have cash, we have marketable securities, we have inventory, we have accounts receivable, we have prepaid stuff, right? Based on the liquidity order. That is exactly why this liquidity order coming from this structure on the balance sheet. So inventory is so fragile, we cannot control too much, okay? We don't know if it's gonna sell or not. Therefore, quick ratio is more stringent because it excludes the inventory part of it, okay? Therefore, if current assets is being excluded from inventory, it is said to be that they are quick assets, okay? Quick assets right here. Quick assets are everything in the current assets section but the inventory. Again, quick assets includes everything but inventory. Therefore, the equation for QR should be quick ratio is equal to current assets, quick assets over current liabilities, okay? You can read up on this. This is pertaining to inventory section. That's exactly why it's written over here for the reasons for why we exclude inventory. Again, the benchmark for the quick ratio is 1. We are going to compare our value, our outcome with the benchmark 1, so that we will be able to make a healthy judgment about the quick ratio. Take a look at this example, guys. I will show you right now. Let's just use the Meg's Luxury Resort again. $1,340,000 in current assets, and then total quick assets total up to $1,240,000. By the way, quick assets always less than current assets, always lower than current, quick assets always lower than current assets, and then same amount of current liabilities we have. As you can see the equation over here, quick ratio is equal to total quick assets over current liabilities. So we have all the components of the QR equation. All we have to do after this point is to plug in the numbers, do the simple math, and come up with a judgment, okay? And our judgment becomes very critical because the math portion of the solution is not a big deal, it's very simple, okay? So when I plug in the quick assets over here and divide it by the current liabilities, I have 1.14 times. So I'm going to compare 1.14 with the benchmark, which is 1. Clearly, 1.14 is higher than, greater than 1, okay? So is that a good thing? Of course it's a good thing, because also, just like in the current ratio, as a decision maker, as a company, you want your quick ratio to be higher than the benchmark, because it is your financial benefit in terms of liquidity. That means for every dollar worth of current liabilities, this resort, Mag's Resort, has $1.14 in quick assets, and this extra chunk of $14 can be used for other payments, other bills, or investments, or any other purposes as well. Therefore, again, it is firm's benefit to have high quick ratio in their operations. So bottom line, CR and QR are very similar in nature. The only difference becomes the inventory, because as you know, QR excludes the inventory, because inventory is so financially fragile. That's what I call financially fragile, because we don't know when the inventory is going to be sold to the customers, okay? Guys, operating cash flows to current liabilities ratio is another liquidity ratio we have right here. So what I do, OCF to current liabilities ratio, CL, okay, current liabilities, or CFCL. Let's just make it a little simpler. CFCL is another ratio we have under liquidity. Okay, let me just put it over here. Liquidity, okay. This is Q. Let me just rewrite it. Sorry, excuse me. Liquidity. Okay. This measure of liquidity compares the cash flow from the firm's operating activities to its current obligations. How much cash flows we generate from our operations to cover our current liabilities. CF over CL ratio answers this question, guys, okay? So we have to deal with an average calculations over here, as I will show you right now, okay? This ratio, as I said, provides an indication of company's ability to cover its current liabilities using your cash flows. Look, in previous ratios, what we did, we tried to understand if we are going to be able to, as a company, if we are going to be able to cover our current liabilities using our current assets and quick assets. This time, we are going to measure if we can pay our current liabilities using our cash flows that we generate using our assets, okay? That is exactly why we need to analyze this, because take a look. We are trying to touch base with every single corner and edge in our balance sheet, in the current assets and current liabilities section of balance sheet, to understand fully, because if we cannot, let's say, if we don't have enough current assets to cover current liabilities, we can use current cash flows over here. Or if we don't have enough cash flows, we can always go back and take a look at the quick assets. So if we have enough current liabilities, well, we have to cover them anyways. We have to pay our bills anyways. We have to pay our short bills anyways, right? Short-term bills anyways. So if we don't have enough cash flows, we have to go quick ratio or the current ratio to see quick assets and the current assets to see if we can calculate or if we can cover our short-term liabilities, okay? Of course, the higher ratio, the better for the company, and an acceptable percentage for the hospitality businesses should be the range 80% and above. 80% meaning 80% of your current liabilities can be paid off using your operating cash flows or cash flows in short, okay? So it is a good thing for the companies. Take a look at this example right here, guys. Corinne Lodging Suites has a total of this amount of in operating cash flows for the year 2012. Also, this firm acquired the total current liabilities of this amount and this amount in 2011 and 2012 respectively. What is the operating cash flow to current liabilities ratio for Corinne? Guys, since we have two different cash flows over here. Oh, I'm sorry. We have two different current liabilities over here in this question. Why? Because in the equation, this is the equation, operating cash flows to current liabilities ratio will be equal to operating cash flow over average current liabilities, okay? Average current liabilities, we have to take the average. Well, you can, please take a look at this. This is the equation for how to take, showing how to take the average. Total current liabilities in the prior year plus total current liabilities in the current year over 2. So x plus y over, x plus y over 2. It gives us the arithmetic average of any single value. So please keep that in mind because we will be dealing with average values in later sections of the chapter. So every single component of the equation is given to us. All we have to do, guys, we have to plug in the numbers and then run the simple math equation. So $1,030,000 over the average of the current liabilities for 2011-2012, you can see over 2 is going to give us 87.73%, okay? What does that mean? Very important. Only 87.73 cents of each dollar of cash flow from activities were provided by this firm in 2012, meaning for every dollar of current liabilities, we have 87.73 cents. It's not enough. There is a remaining 12.27 cents. It is not enough. What are we going to do? Since we are short of, let me just rewrite this. Since we are short of this amount right here, okay, because our cash flows are not enough to cover a dollar value of current liabilities, we only have 87.73 cents. All we have to do, this amount will be covered by either using current assets or current assets or the quick assets, okay, guys? Because we have to cover the 100% of current liabilities, which is 1. Therefore, 80% or higher is okay, even though it is less than 1. It should be okay. It is okay for the hospitality companies because there is always other resources that the companies can utilize, such as current assets and the quick assets. Okay, guys. So please don't forget, in real life nothing is perfect. Therefore, we might have to, as a decision maker, find different resources to pay off our short-term debt or long-term debt, whatever we are dealing with, okay? So this was a CF over CL ratio. You can read what I wrote over here, but that's what we are talking right now, okay? Accounts receivable turnover, or ART, is another ratio I would like to bring to the table because it shows firm's efficiency or number of times in collecting its receivable balance in an operating cycle, usually 1 year, okay? So ask yourself, would you like, as a finance guy, as a revenue guy, as the number guy in hospitality operation, would you like to have higher accounts receivable turnover ratio or lower turnover ratio? In other words, would you like to collect the money you have out there? Somebody's going to pay you that money because it's accounts receivable, right? Money you have out there which will be paid sometime in the future. Would you like to collect that amount of money quicker, faster, or slower, or lower, okay? And of course, generally, take a look at this, a high value of accounts receivable turnover is favorable, and lower figure may indicate inefficiency in collecting outstanding sales using the credit sales. Okay, these are the credit sales. Of course, you want this ratio as high as possible, just like CFCL, QR, and CR ratio. Okay, analysis. Take a look at this example, guys, and then everything will be fine. After that, we had the simple example, okay? But again, interpretation becomes very essential for the ratios. Take a look at the Gala Retail Enterprises total revenue of this amount at the end of 2011. Its account receivable at the beginning of 2011 was $98,000. This is also at the end of 2010, don't forget. At the end of 2011, its ART was $135,000. What is the ART for Gala in 2011? Guys, we have two values again, meaning we have to deal with the averages. Take a look at the solution part of this. Take a look at the solution part. Accounts receivable turnover is equal to total credit revenue, TCR, okay, over average accounts receivable, okay, AR or RT, whatever you want to call it. It can be different, okay? So how are we going to deal with this, guys? Take a look. We can take the average, this is how we take the average. ART at the beginning of the year plus ART at the end of the year over 2. So this amount we have for the total credit revenue, and then $98,000 plus $135,000, and the whole thing is divided by 2, 12.98 times. So your accounts receivable is 12.98 times. What does that mean? Very important. This number indicates that total revenue for the year 2011 is 12.98 times the accounts receivable. In other words, the management of this firm was able to collect its account receivable 12.98 times given in the entire year, okay? 12.98 times, almost 13 times, you are collecting your money, outstanding money that you have, okay, from the vendors, from the people, from the employees, from anybody, from the suppliers, anybody, okay? Therefore, a higher turnover, ART turnover, that's what you need. It is financially beneficial. Higher ART turnover is always financially beneficial to the firms, and lower ART turnover indicates a not so good management efficiency in collecting accounts receivable. Okay, guys? Average collection period, ACP, is another very important liquidity ratio. ART and ACP, let me just do this. ART and ACP, they go hand in hand because they are very related to each other. Okay, they are very related to each other due to its nature. So this ratio is the variation of account receivable. I will tell you what it is right now. Okay. Approximate amount of time that it takes for a business to receive payments owed from its customer and clients and vendors and suppliers. So how many days you're collecting your accounts, your collections, ART collections, okay? What is the efficiency? What is the frequency of it, okay? So this ratio answers the question. This ratio manages the management efficiency of the accounts receivable collection policy, okay? You need to have a great collection policy because it's your money out there, and you can use your money for something else, for your business, rather than somebody else's, like, such as vendors or suppliers, using your money. Ask yourself right now, do you want a higher ACP or lower ACP? You want higher ART, lower ACP. Why? Take a look. Average collection policy, lower average collection policy represents efficient collection. Would you like to collect your account receivable every day, or would you like to collect your receivables every 15 days? Of course, every day. That is exactly why ACP, lower ACP, is required. Lower ACP shows management's ART collection policy, great ART collection policy. Therefore, it's firm's benefit. Take a look at Gala Enterprise again. Let's just use the Gala Enterprise again. Okay, we have all the. Please take a look. Please use the previous example for the numerical values. Average collection period is equal to. So excuse me, I just put it over here. 365. 365 over ART. Look, we need this guy to find ACP. That's why they are very related. So 28.12 days, almost 29 days. That means every 29 days. Gala Enterprises collects chunk of money from the vendors, from the suppliers, from whoever Gala does business with. Okay, guys, the last liquidity Last liquidity ratio is the working capital turnover. Working capital turnover is just like a petty cash, okay? Working capital turnover shows the firm's effectiveness of using their working capital to generate revenues, okay? Working capital, there are two things I would like to mention over here. Working capital by itself is equal to difference between current assets and the current liabilities. And the working capital turnover is calculated by dividing the total revenue by average working capital. So we need to calculate working capital first. Then we can calculate VCT, which is the turnover. Guys, working capital is, as I said, it's just like a petty cash, which means it is the amount of money you need for day-to-day operations, for unexpected expenses, for example, unexpected situations. For most businesses, managers prefer high working capital turnover ratio but low working capital because the management desires to generate and maintain an adequate amount of sales to cover the cost of sales and unexpected expenses on day-to-day operations. Okay, guys? So take a look at this for the Hudson Hotel, and then we will talk about the dynamics a little bit in detail. The Hudson Hotel obtained a total of this amount right here in revenues in year 2012. Its current assets were $401,000 and $435,000, and its current total liabilities were $314K and $346K in years 11 and 12 respectively. What is the working capital in both 2011 and 2012, and what is the working capital turnover in 2012? Guys, working capital and working capital turnover are not the same thing. Working capital is the difference between current assets and current liabilities. Working capital turnover, as you can see right here, is the total revenue over average working capital. Total revenue over average working capital. So working capital turnover right here, this is turnover. We have to find working capitals first so that we can calculate the working capital turnover, okay? So if we go up, let me scroll down. If we go up, working capital is equal to current assets minus current liabilities. For 2011, it is $87,000, okay? For 2012, it is $89,000, CA over CL right here, okay? Therefore, working capital turnover in 2012, I have to take the average working capitals that I find from the previous calculation, which is 87,000 plus 89 over 2, all right? And then total revenue is given to me as this amount, right? So when I do the math, 19.07 times, that means this 19.7 times, okay. Working capital of 2011 and 2012, they were used 19.07 times during the year. In other words, the management needs an average of, because $88,000 is the average of these, okay? On average, $88,000 to maintain the operations 19.07 times during 2012 to maintain revenue levels, to maintain sales and everything. So for unexpected conditions and all that, management needs $88,000 on average 19.07 times. Okay, guys? So that's exactly what it means, working capital turnover. It shows how much capital works for you for day-to-day operations, unexpected expenses, and all that. Okay?